Well, good afternoon, and thank you for attending today's presentation on protecting your retirement nest egg. My name is Gary Munz, and I'm a Regional Marketing Director with One America. This is my 36th year in financial services, but the more important number is the last 26. For the last 26 years, I've specialized in asset-based long-term care, and that's one of the topics that we're going to cover tonight. So, as we get into this, let's try to keep this pretty informal. I'm just going to give you an overview of this marketplace, what's been happening, but please, and again, although we leave it open for questions at the end, please feel free to stop me at any time if you have questions along the way. So when we're talking about retirement and protecting that nest egg, the first thing that we need to keep in mind is, well, what are some of the items that could come up where the expenses could exceed your income? I mean, because that's what retirement's all about. You know, before you get to retirement, it's about accumulating assets. Once you get to retirement, it's all about your income. You know, income for life. So the first thing that comes up is inflation. And obviously, as you've been working with your planner, with your agent, that's a term that I'm sure that they've discussed over and over again with you to make sure that your plans, whatever they've set up for you, however you have your diversification, that you're taking inflation into consideration. Another item that comes up is market downturns. You know, the market can go up, the market can go down. But once again, we're talking about people that are at retirement. They're close to or are already retired. And so this tends not to be quite as much of an issue for the simple reason that the closer we get to retirement, we tend to be much more conservative. And so we want to make sure that maybe we don't get as much return on the money, but we're always getting a return on the money. We're not losing any principal. So once again, usually the agents have spent a fair amount of time covering this with the clientele. But here's the third area that could impact the majority of us, and that's healthcare. Specifically, what if you need extended healthcare at retirement? And this is an area that's coming up much more frequently through the years. Now, what are we talking about when we say extended healthcare? We're talking about, sometimes you'll see it referred to as custodial care or long-term care. And it's based on getting to a stage in your life where you need assistance. You're going to need assistance in the activities of daily living. You know, the eating, dressing, bathing, toileting, transferring, that type of thing. Now, or it also could be due to a cognitive impairment, you know, such as Alzheimer's or dementia. Now, usually the minute that we say long-term care, the customers immediately want to go right to the nursing home. It doesn't have to be necessarily a nursing home stay. It could be, or it could just be stay at home, home care, or assisted living. Those types of things are all covered in this topic. Now, what are we really talking about? Now, that was more of a definition, but what does it mean when we break it down? We're talking about being able to live out the last days of our lives as comfortably as possible with as much dignity as possible. And I think that's really the key concept behind all of this. So, what are some of the consequences for being unprepared? Because we're hearing so many people don't have a plan. Well, first of all, it takes a burden on the spouse. I can't tell you how many times over the years, you know, having worked in this product line for almost 3 decades now, that I've heard, well, I don't have to worry about it, my spouse will take care of me. Well, let me give you an example. I'm 5'10", and on a good day, 215, on a bad day, 220. My spouse could not physically lift me off the ground or carry me to a bathtub or help me get me out of a bathtub. So the first thing that we want to point out is, in the past, that might have been the common response, but what we found now, as there's been more research, over the years we can see that where people have tried to rely on their spouse to provide care, what they've really done is condemn that person to also ending up needing long-term care themselves. It's such a physically and emotionally demanding job that at some point, the healthy person that was providing the care will also need to care themselves. Well, then the other thing that we've heard over the years quite a bit is, well, my children will take care of it. You know, that's why you have kids, right? You take care of them when they're little, and they're supposed to take care of you when you're older. And in theory, that makes sense. I understand it. But there are a couple of issues that come up. The first is, how spread out is the family? Is this even practical? Just to use myself as an example, my father, before he passed away, most of his life he lived in Wisconsin, but he retired down to Phoenix. Now I'm still in Wisconsin. I have an older brother that's in Colorado. I have a younger brother that's also in Wisconsin, but in another part of the state. So my mother is still alive. So the question is, if she needs help, which one of us is supposed to do it? Now, is she moving out of state to get care? Or are one of them moving to come back here? How is this going to work? So is that even feasible or possible? The second part of this is it feasible from a work standpoint? It was not that unusual for our parents' generation that one of the two worked outside of the home and one worked inside of the home. My father was an accountant. My mother was a nurse, but while we were very young, she stayed home. She was a homemaker. So back then, you could see that there was a spouse at home, so it was possible. Think about your kids today, your adult children. If you needed assistance, are your adult children married? And if they are both of those two working, or is one of them staying at home? What we're finding today is, most of our adult children, both of them are working just to make ends meet. They have to pay off the college tuition, and they're paying off their mortgage and trying to get their kids, your grandkids, started. So in most cases, your kids, your adult children, not only are they working, but their spouses probably is working as well. So now the question is, who's putting their career on hold to be available to become a caregiver? Is that possible? So there's a few different issues that come up along the way when we talk about trying to rely on the kids. I think another part of this conversation has to be the effect that it has on the family dynamics, the relationship, if one in particular is asked to provide the care. Let's give you an example. Let's say that in our hypothetical case, that we have 3 children, we have 2 sons and 1 daughter. In most cases, who are we going to select to provide care? The daughter. Now why is that? Any thoughts? They're more nurturing. You think of girls, of females as being more nurturing. If your son drops you, you might not even say, I'm sorry. Your daughter would realize that there was a problem there. I'm obviously joking, but we think of the daughters as being much more nurturing. And so now, let's use that as our example. So we have three adult children, 2 sons and 1 daughter, and we decide that we want our daughter to provide care for us. Now, we also just came from our attorney where we drafted our will, and upon our death, how are we dividing our assets? Equally. Right. I'm telling you, we've seen it come up over and over again, and the problems it's causing within families, because we're saying we want this person to provide the care, either because it's the girl or because she's closer, but we're asking one of the children to provide all of the care, yet we're going to treat them all equally from a financial standpoint. I'm telling you it's an issue that needs to be resolved because it's causing problems within the family. So what are some of the other consequences of being prepared? Well, there are certain losses that are never going to be able to be taken care of, at the loss of a parent or grandparent. But there are certainly some financial losses that we can address. And that's what we want to do with proper planning. We want to be able to take a look at how can we protect that nest egg. So what are our choices? What are our options right now to fund an extended health care? Well, the first is long-term care insurance. Now, long-term care insurance has been around for over 40 years now. The first contracts were written back in 1974. Back then it was just considered nursing home insurance. It only covered you if you went into a nursing home. Along the way, over the years, the products and the companies, they've evolved, they've changed, they've improved, they've become much more comprehensive in the type of coverage that they provide. But they have some some issues, and we want to talk about that. The second option is going to be government programs. And I think the two topics, the two items here are Medicare and Medicaid, and we'll take a minute to go through those programs. Then we've got self-funding for those people typically that are the higher net worth, that are comfortable that through their success, either at their job, you know, many times with business owners or just family money, that they're fairly confident that they have enough assets that they could take care of it themselves. And then finally, we'll get into this last concept, and that's what I mentioned earlier, and that's asset-based long-term care. So let's start with long-term care insurance. As I mentioned earlier, it's been around a little bit longer. It goes all the way back to 1974. And most people agree that it's a pretty good concept for handling this. If you take a look at what do you pay in premiums versus if there is a claim, what will they pay you in benefits? You know, it's a slot machine. You know, you're putting in quarters, but they're paying out dollars, you know, if you need the care. So most people agree that there's certainly a benefit there. From that standpoint, you can get back a lot more in benefit than you paid in a premium. So then, what are some of the other considerations, and why are we seeing that there's not quite as much interest in this as initially anticipated? Well, first of all, some people just see it as another bill. So it is a type of premium that you have to pay. They used to offer paid-up contracts. You know, many of the companies would offer you a 10 pay or a 20 pay, so in a short period of time you could be done with this, not have to worry about it. Most of those, unfortunately, have vanished, so you're expected to pay for this for the rest of your life. The next issue might be health qualifications. You know, the older we get, we have more and more issues that come up, and the underwriting on some of these contracts with some of these companies has certainly tightened. So the question now becomes, at a point in my life where I'm ready to look at this type of insurance, am I going to be healthy enough to qualify? Next is the rates themselves. Are they affordable? And usually this isn't a question of, could I afford it up front? That's not a concern. The bigger concern is, with this type of insurance, is can I afford it 5, 10, 15, 20 years later when I need it? In other words, are these premiums guaranteed? And the answer is no, they're not. With the traditional or health-based long-term care insurance, the companies reserve the right to increase their rates based on claims experience. And so that's what's happened over the last handful of decades. There were a few companies out there when I first started getting into this marketplace that they actually were advertising the fact that they had never taken a rate increase. And the two companies particularly that come to mind are both now out of that industry altogether. They still service their existing old policies, but they no longer write any new ones. So with this type of insurance, what's happened is rate increases are no longer just a possibility, but they tell you at the time of your application that you should pretty much expect these premiums to go up down the road. And then finally, are the benefits payable if the care is actually needed? So I think the companies that have gotten out of the business that are still doing a good job of covering those contracts that they wrote in the past. The other part of this is, what if you're the group that never needs the care? So we know that there's a 70% chance, if you're 65 or older, there's a 70% chance you're going to need some form of care, whether it's in a nursing home or home care, adult daycare, assisted living. What about the 30% that never needs it? You know, they die without needing a long-term care. Well, then in this case, then those premiums are gone. And so for some people, that also becomes an objection that it's a use it or lose it type of a proposition. So what about the government? There was a while not too long ago that there was a lot of publicity about the government offering long-term care for everyone. And their first attempt to put out a government long-term care contract was terrible. And as you probably know, that those products are already gone, they're all out of the market. There's not going to be anytime soon a government long-term care just because it's so expensive. So what government coverage is there? And there are two that most people are familiar with. The first is Medicare. Now Medicare does a tremendous job with things like hospitalization and doctor bills. That's what it was designed to do. But Medicare was never designed to be the long-term care component. And so Medicare is very exclusive. Medicare says, if you're hospitalized, and then after a minimum stay in the hospital, you go to a skilled facility, then they can provide benefits, but even those benefits are limited. And typically it's 100% of the first 20 days and then a portion of the next 80. But after 100 days, typically your benefit stops. So Medicare was always just a short-term coverage, not long-term care. What about Medicaid? This is the one that's more familiar. Medicaid is actually under Title 19 of the welfare provisions. Medicare was originally designed for people that had little or no assets, that the government said, well, at this point in your life, we'll help you with this. We'll take care of your long-term care. Well then, somehow it got a little twisted and a little bit, people were kind of trying to reshape it into something else. And I know for years that there was a lot of Medicare planning that was being done. And the concept was, well, let me show you how we can get assets out of your name so you qualify for the Medicaid benefit. Well, you're seeing that a lot of that has stopped. Now, there's still a little bit of that taking place, but the rules have changed dramatically. The key here is, and the benefits, as it says, the benefits do vary by state, but the key here is to qualify for Medicaid, you have to be at a spend down process first. You have to be basically at a point where you're at a poverty level. Now, it varies a little bit from state to state how much you're allowed to keep, but the question now is, why would you want to transfer all of these assets out of your name to get down to a poverty level to qualify for this benefit? Especially when you find out that some of the options are not available. For example, as it mentions here, the most popular option for long-term care is, if I could choose where I wanted to receive benefits, I want to stay at home. I want to take advantage of home care. Well, home care is not offered under Medicaid. The next thing I want to be able to do is, certainly if I needed to go to a nursing home, I certainly would like the option of being able to go out and take a look at the ones that were near me, and which ones did I like, which ones did I feel most comfortable with. Or if I can't do it for myself, you know, that my spouse or somebody is doing that for me, they're investigating them. Which ones are easier to get to, which ones are they really comfortable with? That's no longer a possibility either, because you don't get to choose. With Medicaid, they tell you where's the next available bed. The concern here is really the lack of coverage, number one, and giving up so much control. So for many people, Medicaid is not going to be the answer. If they're middle income on up to higher net worth, Medicaid you're going to see is probably not the right choice. That brings us to the third option, which was self-funding. Now, the obvious exposure here is you're taking on 100% of the risk. And if you take a look at something like averages, maybe you feel okay because you've set aside a little bit of funds. You know, you're in a pretty decent position. You've got your income needs being met. You have some rainy day funds or some emergency cash someplace. And so your thought is, yeah, for the typical average stay, I can cover that. You know, I think what we've seen nationally is the long-term care claims, the average claims for the United States is still under 4 years. For a nursing home, men typically are in the nursing homes for a little over 2 years and women a little under 4 years. That's the national average. So a lot of people might think, well, I could take care of it. You know, I have enough in assets that if it was only a 2 to 4 year stay, I could come up with that. What are they leaving out? They're leaving out the catastrophic claims. What happens? What happens if it's not that average stay? What happens if it's Alzheimer's? I don't know if you've been keeping up with this, but there's pretty much a new article about Alzheimer's in the newspaper and in the magazines or on the news. Pretty much every month there's something new on there. Not too long ago there was an article in October of last year in the USA Today. And the headline on the business, on the money section was, you're okay for long-term care if you have at least $750,000 set aside. What was their point? The average Alzheimer's claim is already up to 8 years. All right? So that's the problem with being a self-funder, is you might be able to handle the short claims, but what if it's Alzheimer's or any other form of dementia? If it's a catastrophic loss, we could be talking about millions. So that brings us to asset-based long-term care. And asset-based long-term care means that we're going to bring in life insurance or annuities. We're going to have long-term care benefits in either a life insurance or an annuity policy. Now, these products haven't been around quite as long. Like I said, traditional long-term care goes all the way back to 1974. These products, the very first one was filed in 1988 and the first policy was sold in 1989. So they came out 15 years later. But selling the first policy in 1989, you can see we already have 27 years experience, almost 3 decades of experience in this marketplace. Now, why have they been successful? The first thing that is, if you need the care, the benefits are excellent. In fact, there are companies like ours that will even give you unlimited lifetime benefits. Now, a lot of companies, there's a couple of companies that offer these asset-based long-term care products, but I'm going to go back. The others don't offer lifetime. At this point in time, we're the only ones in this marketplace that are offering an unlimited lifetime benefit. So if you need the care, we can give you a tremendous amount of care and the benefits are income tax free. If you never need it, because we're tying it to a life insurance policy, it's not use it or lose it. If you don't need it for yourself or your spouse, we're going to pass it to your heirs, your children or grandchildren at the time of your death. That's what life insurance does. It passes those benefits and it passes them income tax free. What's been left out here, but something else that's key is this continues to grow as an asset. So the money that's put in here is not lost. If at some reason, at some point down the road, for any reason, you decide this is not the right fit for you and you want to walk away, you get cash back. All right? Now, it also mentions that there are premiums involved, and the way that our company has set these premiums up, they're 100% guaranteed. So the type of product that we use on the life insurance side is called the whole life. With a whole life insurance policy, the premium can never go up. Once it's issued, that premium is locked in forever. So you won't see those surprises that you might get on the traditional side, where some companies have even doubled the premiums in 1 year. This is an example of what it would look like. Our starting point typically with a customer, if they've already looked at traditional long-term care and they decide, that's not for me because it's use it or lose it, and they're not wealthy enough that they feel comfortable self-funding, our first question would be, if you had to pay for this tomorrow, what would you liquidate first to pay for this? Now this couple said, well, I've got money in a CD, I've got money in a bank. $150,000 in a CD, that's what I would use. Well, asset-based long-term care, we're going to talk about repositioning that lump sum. We're going to move that money from the bank, the CD, into the insurance company, into our life long-term care product. And this is what it would look like. So this is a couple with both age 65 and in reasonable health. And based on their age, we're going to set up a death benefit. And the death benefit here, you can see, is just over $250,000. All right? So they put in $150,000, and the death benefit's a little over $250,000. Now, when we do this, we can do this on an individual or a joint basis. In this case, we decided to use a joint contract. So we're covering 2 people with 1 policy. That means at the death benefit is only going to be paid when the second one dies. Now, the reason for that is when the first spouse dies, we don't want to pay any death benefit. We want the balance to be there to provide long-term care for the surviving spouse. So the death benefit is only paid at the second death. Now, usually when I mention that this is a life insurance policy, I know a few people are disappointed because they were hoping this was going to be some brand new product that they had never heard of before, a new development in the industry, and they're not excited because they've heard of life insurance before. Now, why do they feel that way about life insurance? Up to now, what do they know about life insurance? What has to take place before they pay a claim? Somebody has to die. Well, the first thing that's different about this is 100% of this death benefit is immediately available for any form of long-term care. That's the whole point of this. All of the death benefit, not the premium that you put in, but the larger number, the death benefit is immediately available for any form of long-term care. And they're all covered. Nursing home, home care, adult daycare, assisted living, they're all covered. Now the question is, how quickly can you get the money out? The way it's set up, you can pull the money out a couple different ways, but the most common way is it comes out 2% of the death benefit per month. Well, 2% of this death benefit, that's $5,100 a month. A little over $60,000 a year could come out for any form of long-term care. So we're saying if either of these two needs any form of long-term care, they can take out over $5,000 a month, over $60,000 a year, income tax-free, until they've exhausted all of this death benefit. Now, what if, it's unusual, but certainly not impossible, what if they both were on claim at the same time? They don't have to cut that $5,100 in half, that monthly benefit. It's 2%, which is $5,100 a month each. So now if they're both pulling out $5,100 a month, if they're both pulling out $60,000 a year, then instead of going 50 months, they would go through all the death benefit in 25 months, in a little over 2 years. But that's the key. We're leveraging their money because we're setting up a larger amount of death benefit, and we're giving both of you access to all of it, income tax-free for any form of care. Well, what else happens? We have cash value growth. Now in this case, they repositioned that CD. They moved it from the bank to the life insurance company. They moved it from one pocket to another. They haven't spent it. They still own it. It's an asset that is under their control. So if they change their mind, the first thing that we do is, we have a guarantee of principal here. We'll give you all of the money back. So they put $150,000 in, 6 months or 3 years later, if they say this is not for me, we'll give them the $150,000 back. Now the longer they keep it, not only will they get back their money, but they're going to get back interest as well. So you can see here that by the 15th year, the guaranteed surrender value in this contract is $173,000. So it's grown almost an additional $25,000 over that period of time. Now, the contract is a whole life. It mentions down here, we are at the guaranteed minimum interest rate of 4%. You're not earning an entire 4% on the 150. We're going to subtract out the insurance charge so that we can provide this death benefit and this long-term care. And on the balance, we pay the 4%. So that means on this account, to grow from 150 to 173, you're probably earning someplace between 1.5% to 2% tax deferred during this period of time. But now think about that. Compare that to that bank rate where it was at. What is the current bank CD rate at? Did anybody see this morning? What are they at right now for 1 year CD? Last time I looked, it was about 0.25%, and you pay a tax on it. This is about 1.5% to 2% tax deferred, no taxes paid as it's accumulating. So now you have what I think is really the beauty of the entire concept. Because there's 3 possible things that can happen. You'll live longer but need care at some point in your life. Or you'll change your mind and want to walk away. Or you'll die without using this. No matter what happens, something is always paid out. Live, die, or quit. Something is always paid out. Now that's just the base policy. We do something else that's really unique here. We give you the option of putting a rider on top. And as I mentioned, we're the only company left that's still offering an unlimited lifetime benefit on that rider. So you could go through $5,000 a month for the first 50 months, which would exhaust $250,000 of death benefit. But then it would be $5,000 a month forever. It can never run out. Now, isn't that the best way of giving you peace of mind of Alzheimer's or dementia claim? That could go for 6, 10, 12, even 15 years. This would never run out. Now the cost of that rider, we can do that either annually or as a lump sum. In this case, they're showing it as annual premium. The thing to point out here is, this is what's called a non-cancelable premium. That's insurance terminology. What does it mean to you? It means the cost can never go up. So we have a whole life policy and a non-cancelable rider. We're saying the cost can never, the premiums can never go up like the contract. If we want higher rates, that can only be for new people with new policies. Once the contract is issued, you're locked in forever. So live, die, or quit, something is always paid out. Now let me just show it to you one other way. Here we're assuming that we're going to put the lump sum into the base, and then we're going to buy that lifetime rider separately with an annual premium. Here I'm just going to change it just a little bit. What if we said that $150,000 CD, I don't want to add anything else to it. I want that to cover the base and the lifetime rider. Okay? So in this case, instead of a death benefit of $250,000, We have a little bit less going to the life policy. So the death benefit's a little bit lower, $225. So that means the monthly benefit's just a little bit lower. It's $4,500 a month. But now, there's no out-of-pocket expense for this lifetime rider. We actually split the $150. We put $130 into the base and about $19,000 into the rider, and now we purchased that lifetime rider. So you move the one-time CD. You move that $150,000 one time, and now you have unlimited lifetime benefits for you and your spouse. Yet if you never need it, your cash continues to grow, you have access to that, and if you don't need that, we're going to pass this income tax free at the second death. Live, die, or quit. Something is always paid out. Now in this case, we're using CD money. It could be CDs, money market, cash, it could be anything that's liquid. There are other ways that we can fund this as well. And one of the more popular is, a lot of people have old annuities. According to the United States government, there is approximately $2 trillion of annuity reserves in the United States. A lot of people, for the last 4 or 5 decades, have purchased annuities. Now, if you purchase one of those, I think it's very important that you key in on this. It's an important concept. The annuities are amazing vehicles. It was a great way to put after-tax money into a vehicle and have it grow tax-deferred. If the bank interest rate was here and taxable, the annuity interest rate was a little bit higher and tax-deferred. So it's growing and in a nice, safe place. But the other part of the annuity is, when you get to retirement, it's called a distribution phase. The annuity can give you an income for life. Well, what if you have money in an annuity and you don't need it for an income? And that's what's happening with a lot of people in this age group. They've done great at saving. They don't need their annuity for an income. It's there for emergencies. Well, let me show you what's happened. If you have someone that put money into an old annuity, let's say $50,000, and over the last couple of decades they picked up $100,000 of interest, so today it's worth $150,000. If they wanted to pull this money out to pay for their long-term care, there's a term for this up here. It's an accounting term. It's called LIFO. Is anybody familiar with that term? You know, what does LIFO stand for?
Last in, first out.
Last in, first out. So they would have to take all of the interest, $100,000, that would have to come out first, and they pay a tax on 100% of it as ordinary income. So they'd go through this money very quickly. Now the government saw that and realized, we know we can't provide long-term care for everybody, but maybe we can provide a tax incentive. And so they did that. They passed the Pension Protection Act in 2006, and it went into effect January 1st of 2010. What did it say? It said, you are allowed to take this old annuity and do a tax-free 1035 exchange. You just take your old annuity and you exchange it for a new one. Now why would you want to do that? If your new annuity is Pension Protection Act compliant, and they had to go back and refile these contracts and add language to these to make them PPA compliant. If it's PPA compliant, it's the same $150,000, but if you pull it out for long-term care, it comes out 100% income tax free. So the larger the gain, the more important this becomes. The question is, boy, if I have an old annuity and I don't need it for an income,